Hey everybody, thank you for joining us tonight on our webinar that's going to be going into the deal that we just put under contract in Belleview, Florida, which is just south of Ocala, Florida. For those that are familiar with our properties in Florida, we do have Free Up Storage Ocala, which is just north of Ocala and St. Anthony, and that's a deal that we're familiar with this market. But today we're going to dive deep into the Bellevue, Florida deal. This is a property that we found off market through cold calling, letter generation that goes out every month, etc. We made a relationship with the seller, and this is a completely off-market transaction, and we were able to really negotiate some favorable terms for the investment. And we're going to talk about all that stuff tonight. Why we like the market, why we like the deal, why we picked Bellevue, Florida, and where that market is going, and kind of all the excitement around this opportunity that we have. So, my name is Ryan Gibson, and I am the Chief Investment Officer with Spartan Investment Group, and tonight we're going to be talking about the Spartan Storage Growth Fund, and specifically the first deal that we have under contract inside of the fund. And for those that are familiar with how our funds work, when you invest in the Spartan Storage Growth Fund, you're going to have a piece of this Bellevue deal and any other deal that follows this property, and we're targeting about 8 to 10 self-storage developments inside of the Growth Fund. But before we get started, I'd like to just get our disclaimers out of the way. We're not offering any legal advice on this webinar tonight. Do your own due diligence. Everything stated is just a projection and a projection only. So that's how all of our offerings are. So please consult your tax and legal team for any questions that you might have on that. And this is just a general overview of everything. We share all of our underwriting files, due diligence reports, feasibility studies, term sheets, whatever we're getting on our projects, we share that in our investor deal room. And if you go to our website, spartan-investors.com, in the top right-hand corner, you'll see the link for our investor dashboard. You can go in there and you can click on the growth fund, and you'll see on the right-hand side our data room where we have our underwriting file and things like that. So for all complete offering details, go to the investor dashboard, talk to one of our team members. We can dive into that and review all offering documents. So with our disclaimers out of the way, again, thanks for joining us tonight on our Spartan Storage Growth Fund offering. Today we're talking about Bellevue, Florida, and why we love it, why we found this deal, and why we're going to take this across the finish line and get it closed this summer and start building a new project. And I think what's really exciting is that we're not going to close on this transaction until we have all building permits in place, and that could happen as soon as June or July of this year, and we plan to break ground and get going on this asset. So we are the general contractor. We're already bidding and getting bids for this project, and we're also the developer, and we're also the operator. So we're going to take this project completely from trees to keys, and we picked this market because we love the growth and the net migration that's coming into Florida. You know, Florida is the third most populous state in the country, and it's also the fastest growing. 40% of Latin America's imports are coming through Florida. There's a lot of jobs moving to Florida. Everybody loves Florida for lots of different reasons. But Bellevue is certainly an area that is benefiting from all this net population growth. And again, we'll get into that stuff later on. But we're about 15 minutes or so from the villages as well, which has seen a tremendous amount of net migration to the area. So what's the bottom line up front? What does this mean to investors? What do investors get in this project? And so we've got some projected returns that this deal contributes. So if the fund were to only buy this one transaction, it would provide a 25% annualized return to investors, and that is about a 2.5x over 6-year hold. So that works out to about a 16.7% IRR. And again, this project itself is going to take, we're projecting conservatively, 6 years to go from trees to keys to stabilization, and we'll get into that later on tonight. So what's our exit strategy? We'll start with that right up front as well. We want to have options, and I think the best part about ground-up development, in my opinion, is that you have options when you have value, right? So if you're making money on the buy, you're going to have options later on down the road. And with this transaction, we're buying this property at a discount off market. So we know that going in, this land is going to have some value built in. This deal is accretive, meaning that we're buying this property for $1.4 million, about $300 an acre, and we see other properties on the market trading for more than that, and we share that in our feasibility study with you. And but we see that when we entitle this site and get it ready and fully permitted, that there's going to be an option to sell this property to another self-storage developer. Somebody who doesn't want to deal with annexing the property and getting the zoning correct and getting all the building permits in place and going through the site plan approval process with the city of Bellevue. That has value. So our investors are going to benefit from that. So the day that we buy this property, we will have it fully entitled. So building permits in hand, shovel-ready project. And so because of that work that our team has been going through since October, investors are going to benefit when we close in the summer timeframe. So at that point, we could sell to an entitled land to a developer. The other thing that we can do is we can build the project, get it to stabilize or get it to C of O or certificate of occupancy. Basically, think of that as like your grand opening. So we can buy the project, go through all the hassle of hiring the contractor and getting all the subs out there to build the property, and then we can sell at certificate of occupancy. And we think there's a high probability of this because Public Storage has taken a vested interest in this area and has recently purchased a big portfolio in the Ocala market. So there is a strong demand for this product type, especially at the rents that we have. The last thing we can do is we can sell it stabilized. And if you've joined us on another webinar, Spartan is the 40th largest owner of self-storage. If you've been paying attention to what's been happening in the space, their Extra Space just bought up Life Storage, and there's many other small, medium-sized operators buying up mom and pops, and there's just a lot of transaction volume, or a lot of businesses looking, or bigger groups, institutional groups looking for this type of product, especially in a market like Florida, where the population is really growing and there's a lot of room to grow rents. So we can sell it stabilized, kind of recapitalize it into a new fund, a lot of different options there. So let's talk about the value. So specifically, I said, we could sell this entitled, we could sell it at C of O, we could sell it stabilized. So what does that really mean to the investor? So let's just say in the first year, we were to buy this property and we were to flip the property. That would produce a project level return of about 25%, and that would give the investors about a 20.9% annual rate of return. So not bad. If we were just to go ahead and just start building it and get it to certificate of occupancy, that would produce about 146% project level return, and that would give our investors about 109% total project return, meaning that they would be annualizing right around 35 to 36%. And then lastly, the last option is to get it stabilized, and we're projecting that to take about 36 months or about 3 years. So that project, once it gets from certificate of occupancy to stabilization, and that would benefit the project about 185%, and give the investors about 150% return over 6 years, about 25% annually. So those are kind of the three main options that we have and what it means to investors. So let's get into the feasibility of this project. Why did we pick Bellevue, Florida? Why do we like this market? First of all, it checks all the boxes for our main buckets in the fund. Strong population growth. There's actually a Dollar General headquarters being built within about 20 miles or 20 minutes from the site. There's tons of jobs moving to the area, tons of net positive migration, retirees and workers alike. Storage demand, there's about 80,000 square feet of unmet storage demand currently within our site, and that is detailed into our feasibility study as well. We have strong rent growth, and we have income growth in the area that really shows that this is trending positively. And then lastly, it checks the box for economies of scale. We have a property about 30 minutes from this location and other properties in Florida as well. So let's take it one step deeper. Let's talk about Marion County, which is the county that Bellevue is part of. The Villages is in the same county or just south of there, which was ranked the fastest growing metro from 2010 to 2020. So pretty impressive population growth in that market. The Villages on the south end actually had another 3,200 homes that are slated for completion in mid-2024. So again, really backing up that population is still moving to this area. And more than 50,000 residential units have been approved since March of 2017 in the greater Marion County area, which is fantastic news for us. And there is an estimated population growth of 1.47% through 2050 in this area. That is substantial. That is 6 times the national population growth over the next 5 years and beyond. So this is a really strong rising tide market which will only benefit self-storage because self-storage is a population game. It's where is the population going, and the number of population or the number of people that are moving to a market will really be a leading indicator of how much storage demand that you're going to have. But let's talk about the site itself, because this also checks a very big box for us. This is located right off the main road. It's a kind of a two-lane boulevard, two-lane road that is a major thoroughfare. When we were standing out there, for 2 minutes, we counted 100 cars that drove by the site. So a very significantly trafficked area. Now, it's one thing to have like a lot of cars that drive by the property. It's another thing for them to be able to easily access your site. And so what we loved is that not only was there 28,500 cars that drive by every single day, but there was really good visibility from both sides of the highway or the freeway or the boulevard, whatever you want to call it. But it was easy access. There's actually a connector between the two sides of the highway that will allow you to drive right into the property. So not only is it easy to see, lots of cars going by, but it's easy to access. So, and then we have excellent frontage from the main road. If you can see here, the two yellow dots, or the two yellow boxes, give us really great visibility from the main road. So when people are driving by, they can see the storage doors, they can know exactly what they're getting on that property. So that we really love the excellent visibility from the main road. The next box that we checked, we spoke to it earlier. Spartan currently has about 4 properties in the state of Florida, and the Belleview property drops right in about 30 minutes from our Ocala property. So we really get that benefits of the economies of scale, payroll, marketing, in the market all the time, more boots on the ground, already have employees there, are familiar with the market, checks all those boxes, and we've really done well in the Ocala market to date. We entered that market in July of 2021. So 4 facilities in Florida, this would be our 5th one. We're building properties. We're actually building a 30,000 square foot expansion at the Palatka facility that kicked off about 2 weeks ago as part of our Southeast portfolio. And we really like the Florida market. Other key highlights of the market is let's zoom in even closer to Bellevue and talk about what's going on within 10 minutes around Bellevue, which is over 1,600 residential units planned and just a really strong pipeline of growth. Specifically, this is covered in our feasibility study, but you can see that within 5 minutes, 1,000 roofs coming in, 6 minutes, another 350 single-family homes, within 10 minutes, another 300, and then approaching completion, I mentioned this earlier, about 20 minutes away, there's a brand new 1 million square foot Dollar Tree distribution facility. So there is significant investment going into this area, and that's driving rooftops, which is going to continue to drive demand for self-storage. So what are we building? What's our site plan? What are we building? Well, we're proposing about 5 buildings, 1 single-story climate-controlled building, so people can drive right up and easily access their unit from the main level, and then 4 sort of single-story drive-up non-climate-controlled units. So overall, about 85,000 gross square feet, and about 76,000 of that is usable, meaning that some space is taken up for corridors and hallways and things like that. But we have a site that has 76,000 net rentable square feet. That's what matters, right? Now, the facility is going to have about 630 units, and 50% of that's climate controlled, 50% of it's exterior drive-up. We have the benefit of doing single-story drive-up, and that is in high demand because while the multi-story glass buildings on Main and Main look great, nobody really wants to go up an elevator. So having a Class A product that's all single-story drive-up with this much rents really checks a lot of boxes. People want that easy access property. They want to drive right up to their door, roll it open, swap out whatever they're doing, and then shut the door and keep going, right? And because we have this 4.63 acres, we could really spread out and provide that unique unit mix that customers really appreciate. So we're buying the land for about $1.4 million, and construction cost is about $6.8. And that's really what we're doing on the development. You can see a picture here. The site's been pretty much shrubbed, kind of cleared, cleaned up of all the debris and trees and things like that. We're buying the property from a landscaping guy who has his own company, who's going to build this into a site, but decided to pass and not build it there. So we really are in an alignment in getting this land purchased and built to built storage. So let's talk about timelines. So we're in Q2 right now, 2023, and we expect entitlements to be fully approved in the coming weeks. And that means that we're going to have our site plan approval, and we're going to have our annexation to the city, and the zoning for self-storage has already been done. And our site plan approval we're expecting in about a month. So we have our site plan approval submission going in a week, and then about a month after that we expect our site plan to be approved, and that will completely check off that first stage of the planning timeline. As soon as our site plan is approved, then we go in for building permits. We're expecting that to happen in Q3 of this year, and then we expect to break ground. I'm being conservative here, but I'm just saying Q4 of 2023. Might happen this summer, but we're really just kind of giving ourselves a little bit of extra cushion there. And then about a year later, we'll have a certificate of occupancy or grand opening of the facility. And then again, we're giving ourselves a conservative 36 months to lease this up, or about 3 years to get it to fully stabilized, about 90% occupied at the rents that are in the marketplace. Speaking of rents, there's strong market rents. So when we look at any ground up development in the country, we're not looking at it unless the market is currently getting about $18 rents. Ideally, we want $20 rents, but $18 rents is absolutely required because of the rising cost of construction. You have to be able to justify the market. So the market rents have to be 18 bucks. So if you look at these colorful bar charts here, you can see that the gold represents where the market is currently at. And it's important to note that that is an average of all different product types, Class A, B, C, all asset class type, or all quality types in the market. And they're getting $18. I'd say the average grade facility is about B in this market, about a B, B minus, something like that. And we're building an A, brand new A-class facility, so we're being conservative in how we're going to do that. Now, let's look at the rent growth. The light blue to the right of the gold is our year one rents. So when we go to market, we start charging our rents and start leasing up our property. We're not going to go off at 18. We're going to go lower than that. We're going to go about 30% below what the market is charging, and that way we can start filling up our property. In year two, we're conservatively saying, okay, we're going to raise the rents a little bit in that dark blue, and we're going to go up to about 15 bucks a foot, 15.86. And then in year three, as we're reaching full occupancy of that property, we're going to be about 20 because the market's going to move. This is 3 years down the road, or 4 years really, if you consider the build and the lease up. We're 4 years into the project, 4 years away from that. And that's where the markets currently are. The market's at 18 right now, so we're saying it's only going to go up a couple of bucks in the next 4 years, which is very conservative. And then we're going to top out at about $21 rents, about $21.88. And we believe this is possible because the market occupancy is about 96%. This is a very highly occupied market. So again, 30% discounted rents, 96% market occupancy, and as I covered before, we're giving ourselves a very long runway with our financing and our extra cash in the bank to make sure that we can do a 36-month lease-up. So speaking of cash, this is how we've assumed the loan to be. And now if you go into our underwriting file on our dashboard, you can see all these financial projections in the dashboard. But just to kind of bring out the key talking points, 1.67% DSCR, or 1.67x DSCR is what we're assuming to be the stabilized debt service coverage ratio. And that's based on 8% debt. So this is an 8% fixed interest rate loan. And that assumes 25-year fully amortizing loan, 8% debt. We're going to achieve a 1.647 projected DSCR. And we're targeting to hold 6 years. We talked about that earlier. So the reality is we've already gone to market and we found a Florida-based lender. They only lend in Florida, and they really like this project, and they want to give us a 6.5% loan, 30-year amortization, and 36 months of interest only. So while all of our underwriting, while all the projections that you see in this presentation are based on these terms, we're actually seeing we're getting a little bit better than that. So that's only going to be to the benefit of the investors. This is a conservative projection based on the market and kind of what's going on. 8%, we know we can get that in our debt fund. We know we can get that cash. So we're starting at a higher interest rate, for conservative sake in the loan, but you can see the numbers are quite healthy for that. So let's talk about construction. So Spartan is building hundreds of thousands of square feet every single year and currently in the market. So we know what contractors are bidding at in Florida. We're licensed in Florida. We're building in Florida right now. We're building in Tennessee. We just finished up a conversion in Arkansas. We built in the state of Washington. We built in Oregon. We've built numerous projects in Texas. So we're pretty dialed in on construction costs. And so we've conservatively estimated that our cost for construction, this is just the buildings and the construction of the site, is going to be about $80 a square foot. Now, our contingency on top of that is a 10% contingency, which all in makes it about $88 a foot. And we know that once we build it, we're going to lose money, right, for probably a couple of years, and we have to fund an interest reserve to make sure that we've got the runway to take this project from completely empty to stabilized and occupied. And in order to do that, we've stuffed away $1.9 million to do that. Now, if we sell this at certificate of occupancy, we won't need that $1.9 million. But we're carrying that to conservatively lease up the property and give ourselves enough runway to do that. And just for feel good, we've got another $210,000 set aside in our budget to give us extra working capital. So we have a 10% construction contingency. We have $1.9 million contingency to lease up the property. And we have another $210,000 just to make sure we have extra cash. And we've underwritten a higher interest rate than what we've received already in term sheets. So we're being ultra conservative on the financials to make sure that we've got a very strong project and we can get it to our business plan completion. So underwriting assumptions. This is probably my favorite slide because it really talks about where the value comes into play. So 9.48 yield to cost, and I'm going to kind of explain what this means. This means that based on the total amount of money that we're going to spend on this project, that's the land, the building permits, the entitlements, that $1.9 million of losses that we use to ramp up the leasing of the facility, our working capital, our construction costs, our contingency, all those numbers, if you added them all up, we would be buying this at basically a 9.48% cap rate. So our total project cost on this deal is $12 million. So that means that our yield on cost is 9.48%. If you were to go buy this facility today, fully stabilized, you'd be paying probably a sub 5 cap or maybe around a 5 cap for this property. But what we said is, okay, we're going to take all the cost, and based on the revenue that this facility produces, we're buying this on a 9.48% yield on cost. Very strong, very healthy. This is what the market would expect to do a very good project with. So 9.48% yield on cost, or yield to cost, sorry. Now, in 6 years from now, we're saying the market, when this property is built and fully stabilized and we've gone through our business plan, the market would value this at about a 5.8% terminal cap rate. Conservative, right? We don't know where cap rates are going to be. This could be lower, it could be higher. It's a projection. But it's a reasonable projection to derive that the facility would then be worth $21.37 million. So that being said, these are just projections, but at the end of the day, that's where the value is. It's right there in the middle. We build at 9.48 yield to cost. We stabilize it, sell it at a 5.8% cap rate. That gives us our terminal value. So very good Class A property, Class A market, well located, REIT-worthy market. This is a very reasonable projection. So talking about the team behind this, my name is Ryan Gibson. I'm the Chief Investment Officer for Spartan and one of the co-founders. Scott Lewis is our CEO, co-founder, and then Ben Lapidus, our CFO. He also has been leading the acquisitions team on finding these properties and underwriting them. And then we're also helmed by Aaron Saunders, our president of president of Spartan Construction Management, and then Matthias Kelmer, who joins us from Extra Space, as he was their former VP of Asset Management. He is now our president of Free Up Storage. Whitney Ham, who's she oversees all of our people as our vice president of people, and then Kevin Holst, who's our chief legal officer. So Kevin really focuses on mitigating risk in our organization. And Spartan, we make up about 123 full-time employees, and we do everything from find and source the deals, find the debt through our capital markets team. We syndicate the equity. We do all the construction management in-house with our own general contractors, helmed by Aaron Saunders. We asset and property manage, and we've purchased about 65 facilities nationwide. You can see up here, this is our map of all the properties that we own. And so we're really big in the Sun Belt region with a lot of facilities and scale in Georgia, Florida, and Tennessee, and also our biggest footprint, which is in Texas. And a little bit more about our construction company. They have over 100 years combined experience. Aaron Saunders is our president of our construction company, and we do everything from the headquarters, executive project management, all the way down to the person in the job shack trailer running the job, right, as our field engineer. So we're doing everything in the process. So we have really strong project controls. And our team has built built some really nice ground up facilities. We built one out here just south of Seattle, one in Sandy, Oregon. We've done a bunch of expansions. Here, these are just some of our offices that we've constructed or renovated or under the Free Up Storage national brand. So speaking of Free Up Storage, this is our Free Up Storage property management company that Spartan owns. It's helmed by Matthias Kellmer, who is our president of Free Up Storage, and we do everything from the top guy at the property management, asset management side of things, all the way down to the store manager. They're all Spartans or Free Up Storage employees. So we directly manage all of the property management in all aspects of the business. We're the 40th largest owner and operator of self-storage in the United States. For the last couple of years, we've been ranked by Inc. 500 as the fastest growing company. We've also made the Vet 100 list, and we have about $600 million of assets, storage assets under management. So as an investor, you can expect a few things. If you invest in the growth fund, you're going to get updates on the first every month. We do things like what's going on in the construction activity, monthly update, financials, trailing 12, etc. And we do monthly distributions if there are distributions, although in the growth fund, we don't anticipate any distributions. So if you want distributions, that's for the income fund or the debt fund. But for this is raw construction. So we're not planning on any distributions. There's going to be a lot of construction activity or buying and positioning facilities that have the most upside potential, but not necessarily the cash flow. And then we send our K1s out in the March timeframe each year. So growth fund, if you're interested in investing, we take money on a first come, first served basis. And then once your money gets deployed, it gets deployed 100% across anything that the growth fund buys. And it's done based on the basis of what we paid for the property. So we don't do mark to market or anything like that. It's all based on the original value that you get or the original value that we bought for the properties for. And then we start doing distributions or otherwise. If there are distributions, mostly these are going to be liquidity events in the growth fund because we're waiting for a property to sell, etc. So let's talk about the splits. Splits are highly favorable to the investor, probably the best splits we've ever provided our investors, which there's 3 share classes based on how much you invest, 50 to a million, million to 3, 3 to a million and above. And so you can see the share classes here, 12% liquidity preference. That means when we sell, the investor has to first be paid a 12% annual return to that point in time before there's any splits with Spartan. And then the split with Spartan is 60-40. So very, very favorable. And you can see if you do the $1 million or more, you get a higher liquidity preference of 14%, 65-35 split. Then it goes even higher than that, 16 for $3 million or more, and 70-30 split. So what does this mean? Well, this means if a B investor is going to make potentially 8% more total return than an A investor, and a C investor is going to make a 7% more than a B investor. So if you're a C investor, you're actually going to get 15% better than an A investor, right? So this is a very highly favorable split, and these are some of the kind of the overall benefits. The other thing is that you're going to get more depreciation as a C investor or a B investor than you would over an A. And what's really cool is if you notice the arrow's pointing up a share, if you invest before May 1st, you actually get bumped up a full share class. And as of this recording, or as of this webinar, there's 12 days left. So if you fund in the next 12 days, you'll get moved up a full class. So if you put in 50K, you won't be an A, you'll be a B. So you get an 8% benefit. If you invest $1 million, you'll get the benefit of a $3 million share. So you'll get moved up a full 15% benefit over an A class or 7% over B. So if you invest in the next 12 days and you fund by May 1st, you'll get that benefit. So if you have any questions to kind of wrap this up, please email us at investors@spartan-investors.com, and we'd be happy to answer any questions that you have about the growth fund. Ted, Ed, Lauren, Roy, myself, we're happy to answer any questions that you might have. And otherwise, we really appreciate you tuning in and learning about this exciting opportunity we have in Bellevue, Florida. And we'll catch up with you on the next update. Thanks, everybody.